Welcome to another episode of The Educated Home Buyer. This is our live Q&A where we take the questions that you guys type in, give you answers, along with updating you on everything that's happening in the economy so that we can help you make sensible decisions as a buyer, seller, investor in today's market. Once again, we have Mr. Josh Lewis back here as our resident mortgage expert to help guide us through the world of mortgage underwriting, all that good stuff. Josh, welcome back.
The wonderful, wacky world of mortgage guidelines. It's funny. You don't realize how goofy and weird a lot of the guidelines are until you tell someone and they go, really? You go, yeah, it's crazy as it sounds. That's what's the guideline.
That's pretty much how it works. So not really a lot of economic data happening over the past week, right? We got home building starts, which came out yesterday, the day before, that impress to the upside, right? Way hotter expectations on that front. But at the end of the day, it starts, right? It's permits pulled. That's not actually homes being constructed at the moment, but it leads the market to believe that builders out there have confidence in the market and therefore are pulling permits, getting ready to build homes at some point in the future, which shows that the economy, again, is still moving along, a lot stronger than a lot of people out there believe that it, should be or is doing, especially for those of us who believe that we might actually be in a recession, even though the employment numbers aren't pointing to that yet. So today, we're going to do like we always do. We're going to dive into some slides. We're going to go over that information, probably first 10 or so minutes of the show. And then we're going to get into some Q&A. But before we do that, a couple of things I want to mention. The Educated Home Buyer channel, the YouTube channel. It's our podcast, kind of a branch off of this channel. It's where we discuss, topics in detail. This last week, we touched on a video on a topic of not buying a home, why you should not buy a home in this market. At the moment, it's our top performing video. So for anybody that's watched it, we appreciate the support. Currently growing that channel. I think we're up to 1,250 subs. So thank you for, everybody that's gone over there and subbed on that channel. It's much appreciated. But if you haven't watched that video, I would urge you to go watch it. I think there's a lot of useful information in there, a lot of things that if you're planning on buying a home, you can take away from it. And if you're not planning on buying a home, you can also take away from it. But more importantly, I wanted to touch on next week's episode. Today, we recorded it. We're debunking the housing crash bros, if you will. We've gone through essentially the top pieces of the argument about a crash coming and debunked it and brought reality to it, what it means. So that's actually going to drop next week on Tuesday morning. It'll be on the podcast. It'll be on YouTube. So if you haven't done so, go check that out. And for those of you who watch the channel and don't know, I'm a real estate agent. I don't only do YouTube. I actually sell houses. And if you're looking to buy a house here locally in Orange County, California, Southern California, I would love the opportunity to guide you through that process. But if you're located anywhere else in the United States, I can refer you to somebody who does business the way that I do. That's one of the advantages of my network is I actually have a large network of people that I talk to all the time. So if you need help there, let me know. And Josh is a lender, a mortgage professional that can also take, through the mortgage process, provide clarity. A lot of you guys are reaching out constantly, using him and having conversations. So for that, we are thankful, but he can help you anywhere on the West Coast and some other states. So I'll put a link up in a minute so you can get in touch with either of us. But that's house cleaning items. Josh, anything before we dive into these slides?
No, let's go to the fun data that everyone loves. The part of the show that everyone tunes in for.
Every single week, we dive into essentially the same 7 or 8 slides on here, and then we bring into some other economic stuff. So every week, I like to start with inventory. Inventory increased week over week 1.8%. I think last week we were sitting at 445,000 homes. This week, nationwide, 451. Again, 6,000 or so homes. Big scheme of things, not anywhere close to what we need. We need to see 15, 20,000 week jumps, excuse me, in order to really get inventory growing. We're not seeing that yet. In fact, we're about to pass under 2022 numbers here really, really soon. Orange County, we're sitting at 2198. That's about 100 homes more than we had last week. So just under 5%. Huntington Beach, we're at 182. I think last week we're at like 169 or so. So we're getting a little bit of an increase there. It's that time of the year. Inventory is growing a little bit because there's, not because necessarily new listings coming into the market, which we'll take a look at here in just a minute, just because listings are sitting a little bit longer on the market. With that said, inventory, again, this is the same graph, just shown in a different way. Just the last 3 years. I think it gives you a little bit of context of what's happened over the last 3 years.
Jeb, when I look at that one, the part that blows my mind is we know how tight the market is and how hard it is for buyers right now. The slope of it looks identical to 2021, but 2021, it was half the inventory right now. Like when we were going through it, we knew it was rough, but looking at it, that this is a tight market now and seeing 2021 had half the inventory or 50% less inventory. But when I look at that, last year was a weird aberration as sellers who really wanted out ran for the exits as rates were going up. The slope of the line as it progresses through the year, super similar to 21, which is, I guess, now a more normal year.
Yeah. And if you're listening to this on the podcast or some other platform, if you want these slides, they are listed in the description below. Even on YouTube here, you can go and get these slides. Excuse me. Wow. Really, really gassy, huh? A little burpy. You can have access to these slides in case there's anything you want to look at again or what have you. It's there. This is a more historical, and I say historical, it only goes back to like 2015, but of inventory, just to give you an idea of ebbs and flows in inventory during different times of the year and taking it back a couple of years to give you some context to where we sit now versus where we were in a more normal market. This is a little bit shocking to me, and the fact that new home inventory makes up about 24% or so of the market inventory. So that's why you're not seeing the housing market crash, if you will, is because a lot of buyers out there, I mean, there's multiple reasons. This is why you're not seeing new construction crash. It's because it makes up such a large percentage of the available inventory at the moment. And that might seem like a negative thing, but when you have very, very little inventory on the market, people are going to, they're going to trend towards that new construction, which is exactly why new construction is continuing to sell, and exactly why builder confidence is so high, because they know at the moment there's a lack of inventory in the market, a lack of it probably coming to the market. So builders know, hey, listen, if we build homes, there's a really good chance buyers are going to come to us. And therefore, they're going to continue to make up a large percentage of the market.
Jeb, that one reminds me of in the Cromford report, 3, 4, 5 months ago, they're saying the builders are sitting pretty because a lot of the stuff that fell out of escrow in the fourth quarter of last year was then available. So buyers were just getting tired of bidding wars, multiple offers on the existing homes, and we're getting pushed to new construction. I think some of those builder sentiment figures that we saw, that's what they're seeing. They're saying, hey, if regular sellers are not going to sell, we can build more and we don't have that to compete against. And that's what that chart is showing. It's kind of wild when you look at, over 25% of the market, but it makes sense in that it's sort of like, you don't worry about, hey, I need a new car. Can I get a Camry? You go to the lot and you pick the Camry you want. It's logical. It's just kind of unexpected.
There you go. Weekly. So weekly numbers, what's happened week over week? We went to 443. I said 445. So it was actually a little bit less. Jumped to 451 as we discussed. Same week last year, we went from 392 to 415. So that's what, 22,000 new listings or so that we added last year. This week, we added 8,000. So big difference when you're looking week over week, year to year. That's something to note. Inventory bottom for 2022 was at 240,000 homes. The peak for this year was 472, which is essentially where we started the year. So we're still well below that. And context, active listings for the same week in 2015 was 1,173,000. So considerably higher than where we are today. Again, 15% fewer homes in contract than this same week last year, 21% fewer new pendings than this time last year. So just less activity this time in the this time of year, less demand. A lot of it has to do with affordability. Inventory is also a factor in there as well. What is this? Immediate sales as percent of new listings. Again, trending down. 7% mortgages slows demand again. So you can see demand is kind of waning a little bit. But if you look and you go back again, look at it year over year. So we're in June now. Go back to June of last year, right? You also have a decline during that period of time. Now, is that because the rates last year were still increasing, or is it because it's summer? Could be a little bit of both, but you can go back to 2021 and look at June during that time. Also, demand goes lower. So we talk about all the time real estate being seasonal, and I'm not trying to make a point here that, hey, the market is better than it is. I'm just saying these are things that you have to pay attention to because they happen every single year, right? This is the time of the year, even though summer is a time when a lot of people think transactions happen, it's a time when demand slows because people are doing other things other than searching for homes. And then median home price, obviously, 455 here. I think California came out today. We're sitting at like 836, 830, somewhere in that ballpark. Median home price, which is, or is it 86? I don't know where it is. Anyway, 860 something maybe. Anyway, increase, pretty decent increase month over month, although it's still down, 6-7% year over year. But just something to pay attention to. 31% of homes out there are having price cuts. That number's up a little bit, about 1%. And that's because homes are sitting on the market a little bit longer. Sellers are having to do things in order to entice buyers in the market where we have 7% rates. So Josh here brought in the housing market index, currently sitting at 55. And you can see there in the regional areas, West is at 50, Midwest 48, New England 52, South 60. So what does that number mean, Josh?
So it's the survey of the NAHB members, asking them basically their sentiment of where they think they're at. So this is the one you were quoting when we were doing the podcast earlier today, Jeb. They should have gone back further on this chart where it goes to January and says that they were at 35. So in the last 6 months, we went from 35 to 55. 50 is kind of like, okay, it's fine. It's not hot, not solid, not in our favor, but there's plenty of traffic. So we're up to 55. So it's a little bit better than above average. But the important thing is back last fall, that number was down in the 20s. So builder sentiment has turned around a lot here recently. The regional stuff shows you most of the country, West, Midwest, Northeast are kind of right there at 50 or just below it. And the South, where it is warm and cheaper, what do you know? The sentiment is much higher.
Yeah, there you go. And until the last 2 days, I wanted to leave California because of weather. Like you would wake up every day. It felt as if we were in Seattle or somewhere that just had gloom constantly. The last 2 days we've seen sunshine. And with that, we've seen better moods from everybody. Josh came in the office today smiling. First time he smiled in months. I mean, in months, this guy came through. What are we looking at here, Josh? So this says, which way will the FOMC, the Federal Market, basically the Fed, Federal Open Market Committee, is that what it is? I don't even know. Which way will the Fed tilt in June? And so we're in June at the moment, but what are we looking at here?
So we're not going to read the whole darn thing to you, but the cool thing is kind of shows you where all of the Fed members sit right now. So we had 5 of the voting members were in favor of 5 members were in favor of hiking, but 2 of them are non-voting members. On the other side, we had 5 that did not want to hike, and then 3 non-voting members. So it tells you that there was a consensus, not unanimous, but there was a consensus to hold for this time being. But then you look, the comments are really important. Powell is the loudest voice in the room, the biggest voice in the room. It's collaborative. They listen and they talk and they debate. But Powell says we can afford to look at data and ongoing outlook. So we're going to go through some of the things they're telling us. The ongoing outlook is for lower inflation. They very well may be able to pause for the rest of the year. They're saying we think we're going to hike 2 more times. Part of that is their words are our policy until next month when we have another vote. Them saying, hey, we think we're going to hike impacts the market. And right now, interest rates are staying elevated because they're saying, hey, we're going to hike a couple more times, and then we're going to decrease rates a bunch next year. Jeb and I talked last week. Why would you hike 2 more times if you're telling us you're going to cut 4 times next year? I think that it's very likely that we've seen the end of the hikes, but it's 100% data dependent. And then I don't think we're going to see 4 cuts next year. I think we're going to kind of stay in this range for a while. But things like this, it's a cool little chart that just shows you where their sentiment is at. And for now, they're more on the sidelines, but looking at the data to see what happens next.
There you go. Good stuff. Payrolls outperformance not in line with overall market conditions. So what does that mean, Josh?
So the labor market condition index, I meant to research this a little bit better so I could tell you guys exactly what that is. But we're watching the non-farm payroll. So we talked about those 2 weeks ago, that this data, it's just not jiving. And it's probably due to that birth death ratio in how they do the establishment survey that's overstating jobs. So the Kansas City Fed does their survey and they're saying, hey, the employment market is turning down and non-farm payrolls are still showing up. So I would be more inclined from what I'm seeing to see that the employment market is still strong, but trending down versus continuing to strengthen, which is what we're seeing from non-farm payrolls.
All right, good stuff. And this is showing GDP.
Yeah, just seeing it again, trending down. It's a pretty clear trend line. It's bouncing around, but absolutely the St. Louis Fed, their GDP now, it's a nowcast. So it can bounce around a lot. There's a lot of noise in there because as soon as information comes in, they're adding it. And there may be another report that's going to strengthen or weaken GDP that hasn't been brought in there. But you can see the trend is pretty much down. Inflation, it is like absent stagflation. We talked about that a little bit earlier when we were recording today, Jeb, but we've had stagflation once in the history of the country where you have low growth and inflation at the same time. Generally, inflation will follow growth down. We're talking about, are we in a recession? Are we going into a recession? Doesn't matter. The economy is clearly slowing and not performing as strong as a lot of people worried, and a lot of the Fed members are concerned and thinking they need to cut more. We're already seeing the weakening.
There you go. And let's take a look at producer price index. So PPI here showing again also trending lower, sitting at the lowest level we've seen since December of 2020. It says.
Back into a normal range. So if we go back here from 2012 to 2020, before this thing went nuts, what was the common theme there? Very low inflation, and the Fed's biggest concern is how are we going to get inflation over 2% or up to 2%? So we see a big spike during COVID, and now we've recovered from this. And producer prices are very predictive and correlated to consumer prices. So the Fed was ignoring this as PPI was shooting to the moon. They're saying, you know what? We think it's going to be okay. And now, as it's dropping like a rock, they're going, oh, we think inflation's still going to be a problem. So it's important to see what the Fed is thinking. It's also not important to think that they actually know what they're doing because they're academics that haven't ever been out in the real world.
There you go. And this shows changes in rents, Zillow rent index versus CPI rents. You can see the Zillow rents are down. We're actually going to take a look at another chart here at the end of this. I didn't put it in the right order clearly. And then CPI rents are
I
just
might have
starting to
moved it
trend
right
lower.
behind this, Jeb, because I wanted to kind of look at them.
Okay, there you go.
Context.
All right, so let's pull that one up too then. So yes, you did actually. Monthly new lease asking rents percentage change from a year earlier. So again, you can see all rents are trending lower, but many of them are still up year over year, which shows you that, rents in most markets are still really, really strong out there. Yeah.
They're strong, and we're going to consider, because consider, Jeb, we talk a lot about the 65-year average nationwide of home prices of 4% inflation. California, 7% inflation. Rents go up. This isn't shocking. 3% should be expected. So what are we looking at? Depending on your measure here, or the median there is probably at about 3.5%. That's to be expected. It has normalized. So remembering, you talked about price momentum and how that is captured in CPI and PCE. This is telling you the momentum is going away and normalizing. And really what we care about when we're expecting where CPI is going to go is year over year. What does it look like relative to last year's baseline? And it's coming way down, and it will get captured in the data rather quickly.
Yeah. And just because, again, the momentum goes away doesn't necessarily mean those rents have to fall, right? They can stay at 0 or 2 or 3 or whatever the number is for an extended period of time. And, without having quote unquote inflation, being a real part of it. So this shows inflation forecasts versus, inflation versus the market and implied. Yeah. Anyway. Forecast and a market implied is what I meant.
The forecast is the Goldman Sachs forecast. As you can see, they keep lowering it down. And the market implied, the market expectations are lower than that and have kind of flattened out here. But both of those are converging down well under 3%. Is that above the Fed's preferred measure? Yes. Does that mean that they're likely to remain hawkish? Yes. But continued hikes and continued high inflation and continued high interest rates, this is telling us that is not going to be the case.
All right, good stuff. This is something we touched on today in our housing crash bros debunking episode. But essentially just shows you, where unemployment rates, what the projections are, currently sitting at 3.7, seeing the Federal Reserve coming at 4.5 is their projection. Bank of America at 4.7, UBS 5.4, Nationwide 5.5, and Josh's friend Jeffrey.
We got to find out who Jeffrey is. I've never known
6.5%. But nevertheless, we're not going to talk about it tonight. But if you want to know stance on what happens when employment goes up, what happens to housing, all of that, we touch on it in next week's episode.
Look at the quote there at the top. The important part is the second half. Over time, if the unemployment rate increases to around 5.5, price declines will spread to the low end of some FHA markets into metros with stagnating or declining job growth. So this is that. I don't disagree with that. It's the American Enterprise Institute. That's their analysis. It's a good data source. But then we have various projections here. Only 2 of them think we get to that 5.5% range. And remembering 5.5% unemployment is a very strong job market. Historically, 5% unemployment has been considered full employment. So 5.5 is barely above that. And most projections are us not getting there. So it's important that these projections will change over time. We're watching them over time. But the expectation is the unemployment rate is going to remain low for the foreseeable future and unlikely to transmit in a major way into home prices.
There you go. Good stuff. All right. One more slide. This shows, what do we got here? 30-year mortgage-backed securities.
Yep. The 5.5% mortgage-backed security. And that box shows you the candles for the entire year. So starting January 1 from high to low. So you see, I had a question. It was actually, I think it might have been in the comments on the Educated Homebuyer channel this week. Someone said, hey, my Google feed keeps saying rates are lower. And then I go and I get a quote and the rates haven't changed. Just remember, the crap you're seeing online is telling you what they want to get you to click and hopefully fill out a form and become a mortgage inquiry that they can sell to a mortgage company somewhere. This shows you that from high to low all year, we're looking at 101.98 as the high, which would remember, bond prices going high pushes yields lower. And then the low back in May was 98.78. So it's 320 basis points from high to low. So the entire year, interest rates from the best to the worst have only varied 0.75%. Is that a big number? It's a big number, but it's not huge. So just remember, rates have been pretty stable, have not moved a heck of a lot. We're somewhere in the middle of that trend right now, and do expect a breakout to lower rates, but over time and much more slowly and gradually than most of us would like.
All right, there you go. So now what we're going to do is you're going to hit the like button, and I'm going to say thank you for doing that. And then we're going to get into your questions. So let me know when you guys have hit the like button, and then I'll say thank you, and then we can get into questions. We good? We good? Thank you. All right, so let's get into some questions. In fact, the Bearded Votto said it best. He said, smash that like button like it owes you money. So I like that. Appreciate it. So Josh, let's start with a question today. Did you put it in a banner?
No, I
did not. Okay. So we had a viewer who listens to the podcast ask, hey, how do I submit a question to you guys? I'm not able. She didn't even know when the live was. So if you're listening to this, it's every Wednesday at 5 p.m. Pacific Standard Time. It's on my channel, Jeb Smith at Jeb Smith on YouTube. It's also tonight streaming on the Educated Homebuyer channel as well, just to see how it does. So it might stream there going forward as well as here. We don't know, but you can always find it at least here. But with that said, Josh, why don't you read the question, or do you want me to read it and you can answer it? I don't have it in front of me. So
yeah, I've got it. So questions about mortgage insurance. The first part is, number one, is the PMI based on the appraised value or the purchased value? My lender says it's based on the purchased value, but a friend of mine told me that his was based on the appraised value. Is it lender dependent? And what about when refinancing? No, it's not lender dependent. It is always going to be dictated by the loan program. And for every loan program other than USDA, and maybe there's another one out there, but anything other than USDA, it's going to be the lesser of the appraised value or the sale price. So if you agree to pay $400,000 for the house, the appraisal comes in at $395,000. They're going to use $395,000 as the number for calculating your loan to value ratio. So if you, again, let's say that $400,000 purchase, you're putting 20% down. It puts you a $320,000 loan amount. Well, when it appraises at $395,000, $320,000 against $395,000 is going to put you at 81, 82% and going to require mortgage insurance. So it's always going to be based off of the loan to value, which is calculated off of the lesser of appraised value or sale price. Not lender dependent. You can go to any lender in the world that's going to be treated the same. Maybe not. Any lender in the United States, it's going to be treated the same. How about that, Jeb?
Yeah, agreed.
Second part here. Have you heard about overpaying PMI? My contract states that they're legally required to remove PMI when I reach 22%, but also states that I can voluntarily remove it when reaching 20%. Why that discrepancy? It means that if I don't pay attention, I would pay PMI for an extra year. So before sort of the government stepped in and said, hey, we need you to get rid of it when you hit 78% of the original loan balance, it would have just sat there forever unless you went to them. So from a lender's perspective, they want a number. They're fine with a number being set in stone as to when it will come off. But you as a homeowner, if you're doing improvements, if the market appreciates, you want to be able to go back to them and petition to have it removed. So you always have that ability. You'll generally have to get an appraisal to prove the value to them. If you've done improvements, you're going to have to show the value of the improvements that you made to the property. But it's not a bad thing, and it's certainly not about you not paying attention, because we're talking a difference of 2% in the loan to value ratio on your home. I don't think most homeowners know the value of their home with enough certainty to know when it hits exactly 80%.
Yeah, and looking at Zillow isn't an accurate
do
way
it.
to get there. SK says some YouTubers are talking about recession. Is a housing market gonna crash soon? So we talked about this earlier in the episode. Next week, we're talking about this in detail. We're debunking these dummies that are out there still talking about crashing and everything else. So next Tuesday, there will be a video on the Educated Homebuyer podcast YouTube channel. Go check it out. It's the Educated Homebuyer podcast, I think is the handle there where you can find it. So subscribe to the channel. It'll pop up, listen to it. That'll give you all the information you need. Ahmad says crash still in question. I thought we were over it. We are. The crash is over. It happened. It was a crash in sales, not prices. So that's taken place. Let's move on. We're not talking about crashes anymore tonight. That is the end of it. Couple of questions here. Bearded Vato says, fall winter is usually slower for the housing market. You think that would have an effect on house prices and interest? Well, I can tell you it's going to have zero impact on interest rates, right? Interest rates aren't impacted by seasonality. Interest rates are impacted by mortgage-backed securities, by inflation, the things that we've talked about numerous times on the show. So what you're likely to see is interest rates probably improve in the second half of the year. How much? Hard to say, but likely improve. Prices are another thing. I do now. Josh and I might disagree on this. I do believe that as the summer continues, demand is going to continue to wane a little bit because affordability is not going to improve. That said, seasonality is going to play a part, which means just less transactions happening out there, less new listings coming to the market, just because who's going to sell when they got a 3% rate? We've talked about that, and inventory is probably going to build a little bit. I could see a market where home prices don't really go up, don't really go down. In fact, some of these reports out there could show year-over-year declines in prices. Now, Josh has had a different stance on that, but I don't think you see an environment where you see a big improvement in prices, but you also don't see an environment where you see prices massively shoot up either. I think you're going to be in this position where, hey, if a nice property comes on the market and you're in a competitive market with quote unquote limited inventory, it's still going to be a competitive situation because there's still a lot of buyers out there that are looking to buy homes, right? I mean, if you're in the market, if you're listening to this, chances are you're probably a willing buyer. So it'll be interesting. So I don't think you should pay attention to the market fall and spring thinking, hey, this is going to be an opportunity for me to get a deal. I think the deal was October last year when rates were, first hit 7%. People were shocked and thought, holy shit, like what happens here? That was the time to do it. Now people have kind of almost got into this comfort zone, if you will. It's not comfortable, but into this mindset where, hey, look, things are probably going to be here for a little bit. So I'm just going to do it because I'm not going to sit around and wait. But Josh, what are your thoughts?
Well, here's the thing. Could we see a repeat of last year as kids go back to school, we hit the holidays, less interested in buying homes, so it decreases demand, still not a lot of supply, so put some downwards pressure on home prices? Absolutely. And maybe that's kind of what the new normal is. You get to the slow part of the year, prices dip a little bit, we get back into the spring, buyers come out of the woodwork and push prices a little bit higher. But the wild card, the most important thing for future direction of prices is affordability. If affordability improves, then prices have some room to go up. I absolutely believe that rates will be improving over the remainder of the year. And it doesn't take much. I don't think much is going to happen. So I'm not saying, hey, rates are going to be 5% by the end of the year. But if we work our way down to 6% between now and the remainder of the year, it will keep a floor under demand. So I think we're on the same page that over time, the next 6, 12, 18, 24 months, we're probably looking at flat to slightly up prices. And certainly the fall season after kids go back to school and we hit the holidays could be slower and be the part of the year that would be most susceptible to price decreases.
There you go. Agreed. Wesley says he was hanging out on the other channel. It was lonely. I think we only got like 9 or 10 people watching over there. So if you guys want to join more people over there, you can. If you want to come back over here, hey, come on over here.
Here's the thing: if you
have the one space,
if you're not subscribed yet, go over there and subscribe, and
and then you come back
and hang out, and then come back.
Yeah, it's all good. So Tony is one of our local friends here that we've never met, and we've talked about Tony on the episode. In fact, we're going to have Tony on. We're going to figure out when and how we're going to do this. But Tony is a local investor. He is he owns assets of his own. I don't know how many doors he has, but he manages his own assets and he's a real estate agent. So he's not only a real estate agent helping buyers and sellers in the market, primarily sellers on the listing side, but he's also someone putting his money where his mouth is and actually investing in real estate. That said, do you think that's a good conversation for one? So let us know in the chat if you want us to have Tony on, because, well, either way, we're going to have him on, but let us know what you think.
Whether you like it or not.
But he asked the question, do you think we'll see more inventory anytime soon? I do think you're going to see more inventory, but it's not going to be a noticeable difference, in my opinion. But I do think you're going to likely see the peak for this year probably in the next 6 weeks. Is that could be a call that goes completely sideways. I don't think that it will, but I think by mid-August, is that 6 weeks or is that 2 months? I don't know. Anyway, by mid-August, you're going to see the peak in inventory. And so from there, inventory stalls and goes, south through the remainder of the year, or maybe it just kind of floats along at those numbers. And then like normal hits the lowest numbers towards the end of the year. But I don't see any reason that we'd see more inventory at this time, especially with the way things are going.
You just got to ask where is it going to come from?
No. Well, I ask myself that all the time. Where is that inventory going to come from? World Trekker, is California going to be less and less landlord friendly? As a landlord, are you worried? So, yeah, I mean, I don't know if it's going to be less and less landlord friendly, but I mean, it's not looking good in the majority of the states. The majority of the counties here in California. Is it political? Is it something else? I don't know. The problem with California is that it is so unaffordable for the majority of people who live in the state. We have a big homeless problem. We've created this society where we've got to help everyone. And I don't know. I don't know. I don't know the answer to it. It's not a good place to be. And I'm not saying that as a landlord. I think as a landlord, you can do your work on the front side to protect yourself for the most part, right? You can never 100% protect yourself, but without having to rely on the county laws to protect you with, tenant laws and tenant versus landlord and all that good stuff, right? You can make sure you have solid applicants up front and kind of avoid some of this stuff. So I wouldn't avoid California real estate, especially if you're looking for a state with that's going to have long-term appreciation. But with that said, you got to make the right decision for you. So Josh, as a landlord, are you worried about California?
I wouldn't say worried. I have the property over in Long Beach. LA County is much worse than anywhere else that I have properties. You were talking about a mutual acquaintance of ours that has multiple properties through LA County. Some of those fall under rent control, and he's buying and still buying more. I don't know. I would be lying if I said it's not a concern. I also would be lying if I said it would stop me from buying. You need to take it into account when you're measuring the deal. And do you like it? Are you comfortable with it?
I mean, here's the reality. Josh and I are looking to buy property right now in California, in this market. So, that said, if you have a property you're looking to sell, somebody that needs to sell, you got somebody that wants a cash offer, sell quickly, that sort of thing. That's what we're looking for in this environment. So we're not your competition, but we are looking to buy property if you know somebody in that position. So I thought I would throw that out there. Just Pulse Powered says, just finished signing closing docs. Can CalHFA fund and close on the same day, Josh?
So CalHFA doesn't fund the loan. They are basically guaranteeing the loan and they're buying it from the lender that is making the loan. You're not applying to CalHFA. You apply to the lender. They send the loan in. CalHFA approves it. So the question really is for your lender. Are they a lender that can do a same day funding? And if so, you should be fine. But hopefully we're not. I mean, we're here at the 11th hour. Are we needing a same day funding? It should be possible, but talk to your lender versus CalHFA.
There you go. And in some counties, it can't record the same day. So even if it does fund and close, you might not get the keys until the following day or what have you because of how that works. So great question here, Josh, from Ricardo says, what if the delta between the 10-year treasuries and mortgage rates never normalize as you have suggested? Could the powers that be decide to permanently keep that gap even as conditions improve? So, Josh, is it possible that gap? I mean, we have discussed the idea that it could stay wider than historical norm of 1.7%, but could it stay at 3% for an extended period of time? Even if other things improve.
I think the important part to answer the question accurately is to look at the second part. Could the powers that be decide to permanently keep that gap even as conditions improve? No one's deciding. They're voting with their dollars. So what they're saying is Mortgage-backed securities are selling at a discount to treasuries. Remember, we want prices higher to make yields lower. So it is cheaper to buy mortgage-backed securities than it is to buy treasuries. And the primary reason there is that treasuries don't have the duration risk. If you buy a 10-year treasury, you have that investment for 10 years and you're going to get your rate of return. When you buy a mortgage, you don't know how soon it's going to pay off. Right now, that risk is higher. So you don't know if that thing's going to be in the books for 12 months, 24 months, 60 months. So therefore, you're willing to pay less. There's also some market volatility measures in there. And we've kind of seen the market all over the place just this year. We've seen that 0.75% range. So as the market gets more stable, as we get to a point where the people that are buying mortgage-backed securities consider that it is a good investment going forward, that those loans are likely to be on the books, it should stabilize. Read a quote from a bond market analyst saying their belief is that 10-year treasuries are going to improve, and that could widen the spreads a little bit further. But at some point, investors will step up and go, I'm willing to pay more for those mortgage-backed securities and bring that spread back in line. So could we have seen the end of that 1.7, 1.8 spread and maybe 2.1, 2.2, 2.4 is the new normal? Absolutely. Can I see any world where it stays at 3%? I just don't think that it's there. You'd have to have a lot of volatility and a lot of concern that rates are going to shoot up, drop, where you just have constant refinances.
All right, good stuff. Couple of other questions coming in here. I'm going to check on real quick. We'll go with Mr. Bill in Florida. Says, how is a median home price a false metric as buyers are now buying at a lower price point? Thought. So, Josh, we've talked about the idea of a median home price before. And while neither of us truly believe that it's an accurate measurement in many ways, because as prices are going up, it's behind on that metric. And as prices are declining, it's a bit behind as well. So what should someone pay attention to more? And why should they follow, say, like a Case-Shiller or one of those?
Median tells you more about market mix. Generally, when we see the big drop in a median, that doesn't mean that home prices drop that much. It means that the high end is suffering more and there's less sales there, and more sales are happening at that low end. So when you look at something like a Case-Shiller that's a paired sales index, they're looking at the same home selling repeatedly over time, and they're taking care of accounting for bed and bath count, square footage, things like that. So it really is an apples to apples comparison versus a change in the market mix. So median's a valuable tool. You want to watch it. It's just the least valuable of all of the metrics when we're trying to look at home prices.
Yeah, I mean, at the moment, we know that median is going to be less because housing affordability is becoming more and more of a problem, right? And on top of that, you've got, less sales happening at the higher price points for a number of reasons. A lot of the people buying luxury real estate, for example, have money in the stock market, are vested in other things. And as those markets, clearly the stock market's still done very well. But, a lot of people in those price points tend to just kind of wait and see versus emotional buying. And, as prices get high, affordability becomes a problem. You have less transactions happening at or below that median price, which in theory pulls that median down. Like Josh said, it's a valuable thing to watch, but seeing that the median decreased by X amount doesn't necessarily mean the home that you're looking at decreased by X amount. And I think that's where people get it wrong. They say, okay, California median home price dropped by 6%. Okay, so that in no way means every home in California dropped by 6%. And that's unfortunately the way that people read it. They think my home dropped by 6%. That is absolutely the wrong way to look at the data versus, hey, there's less sales happening under this price point, which is bringing this number down. So I think we beat that into the ground, but hopefully that provides a little value there. Really simple one to answer here. Willing says, are you going to see Gladiator 2? No. I don't even know what that is. And I haven't seen Gladiator.
The thought has not occurred to either.
I don't even know what is Gladiator. I know what the show Gladiator was. In fact, isn't there a documentary out on it now that I need to watch? I heard it was good. right? Or it was going to be good or something. I don't know. Anyway, we kind of went off on a tangent there. Adventures in backpacking. Do you think the upcoming October repayments of student loans are going to have negative and possibly catastrophic ramifications on some who recently purchased homes in 2022 and 2023? So, absolutely impossible to say for sure, but there will be people that are affected by student loan repayments, right? Because they've got into the idea that I haven't had to make this payment for 3 years and that it's probably going to be extended forever. And so that money that was allocated towards student loans has now been allocated towards other things. So people are going to have to rebudget and figure out how to make it work. It's really that simple, even though it's not simple. That said, could you see more student loan bailout type of stuff and conversations happen in the future? Absolutely. How does that play a part? I have no idea. Josh, what are your thoughts?
Let's look at this fun part. So the question here is specifically about those that purchased homes in 2022 and 2023.
Yep.
Now, the one thing absent forgiveness that the government has been able to do with virtually no pushback is expand income-based repayment programs. I have a client here that came from the channel, Jeb. I don't know if they're a watcher of the show, but watched a video, reached out, closed a dream for all, purchase for her. She recently finished her degree. She got 150, 180, 200. I don't remember exactly. A lot of student loans. Got a raise because of that advanced degree. And next year, her income-based repayment would have gone up because her disposable income had gone up. Well, instead of being a renter with a $1,500 rent payment, she now is a homeowner with a $2,900 payment. I forget what exactly it was, but less disposable income, and she's going to have a lower IBR payment next year as a homeowner than as a renter. So because the IBR stuff takes into account disposable income, which includes your house payment, those that bought are going to be insulated from too much of a problem. And I would like to think that those that were financially sophisticated enough to save a down payment and buy a home have accounted for the fact that at some point they were going to have to start making payments again. So I don't think it will have an impact, but as you said at the beginning of your answer, Jeb, it would be silly to think that there's not going to be some people that are impacted by it.
Oh, absolutely. I think more people probably have forgotten about their student loans than have remembered that they have them. And now maybe I'm just being, pessimistic in that view, but I just know how quickly people forget things and how quickly people can move on and not realize they have things. So it's hard to say at this point. Debt loads and things like this are obviously at all-time highs, right? That stuff has an impact. The question is, does it impact housing? Do those people who are extended on their credit, extended on debt, do they own homes? All of the things that we just don't know the answer to. But time will tell. Time will definitely tell. It has a way of telling a story, and we will be here to narrate it for you. There was a good question that came up, Josh. Let's see here. Did I not click it? In the meantime, David's property fell through. Sorry, David. There will be others out there for you.
What's meant to be will always find a way, Jeb.
Listen to this guy. Willing asked if we could go back to the 2-hour episode. We cannot tonight. I have a 5-year-old who just turned. I have someone who just turned 5 today in my house. Have another son who is getting promoted. No more graduation. He's getting promoted to 6th grade. So we're celebrating this evening. We've got things to do, guys.
What was wrong, unfair, or discriminatory about graduation that it has to be called promotion?
I mean, because he didn't graduate. He got promoted. I have no idea.
Cutting class, smoking behind the gym.
There was no gown, no cap, none of that. So it's just a promotion. Right. So there was a question here we got from Anya. Anya, one of our regular viewers here, says, what are your thoughts? I'm very worried about mortgage-backed securities and banks being hurt by commercial default. So do the two go hand in hand, Josh? And what are your thoughts?
I'm sure there are some banks that have
Yep.
exposure to both, but there's not really any crossover. It's the strength of the collateral that's going to
And
dictate
it's, yeah.
the value of the security itself. So I don't really see a mechanism for crossover unless if you had a bank that got in so much trouble. And we did see this a little bit with Silicon Valley Bank and a few of the others. They didn't get themselves in trouble on the commercial stuff, but they got in trouble and they had mortgage-backed security holdings, and those are having to be offloaded into the market. So it brings additional supply. Is it a concern? Yes, but very minor. It's just the stuff that is impacting and that the commercial market is facing is very, very different than residential.
Yeah, but you will have some bank. I mean, we're not done with bank failures, just so we're clear, at least in my opinion. I think you'll see more of that. And I actually had a slide in the thing that it didn't show up for whatever reason, Josh, that showed just, the reserves and lending tightening for banks and how that's essentially impacted their ability to lend to the consumer because there's just less and less transactions happening out there. So lending is essentially tightening in that market, even though, the word on the street is that the Fed hasn't noticed any tightening in the credit markets, which is mind boggling, seeing that, they had to pump millions, trillions, whatever the number, billions of dollars in there for the banks to stay afloat. But there's no credit tightening problems. We don't see anything. I don't see anything, Josh.
Well, Jeb, here, this leads you to a very similar question. Platinum Black, another regular viewer. What's going on with jumbo rates? Look like they're going crazy. So the majority of jumbo loans are made by banks and held in portfolio. Even if they're not, they're securitized, but they're much smaller pools. And a lot of times they will get pooled and sold to a big bank, a Wells, a Chase, a B of A. And their cost of funds is going through the roof. They don't really have an appetite for these things. 2 years ago, when their cost of funds was at the floor, they're like, hey, how many $1 million loans can we get on the books? They have bigger down payments. They perform better. They have higher credit scores. So that arbitrage between their cost of funds and a 3% mortgage or a 2.75 mortgage was great. Now they're having a very, very hard time getting those returns. I can also tell you, we had a relationship with a credit union that has basically stopped mortgage lending because they have no portfolio runoff. No one's refinancing, no one's selling. So they have no portfolio runoff that they're needing to replace with new originations. And the new originations that they are doing, which they will still do them for members, existing members of the credit union, there's not enough margin in there to make it worthwhile. They're not trying to expand their origination business because there's no profitability there. So the simple answer is banks are not seeing profit in jumbo mortgages. So they are not aggressively pricing them to put them on the books.
There you go. Michael Mitchell says, why does Robert Kiyosaki say the biggest crash we have ever seen before is coming?
He's old and crazy.
He's got some really good books on real estate, on investing. I suggest you read them all. They're all really, really good. That said, he's kind of gone off the deep end the last couple of years. I mean, he's been calling for a crash for the last 3 or 4 years. And that said, he was at a conference that a buddy of mine went to about a year ago with what's the guy's name? David Bett. I can't think of the guy's name. Anyhow, and he basically got into this political rant about like everything. Like it was just like basically like politics were crashing the world, and it was all like the fault of one person. Like, come on, dude. He is very like one-sided at the moment. And I don't have any problem with, people that are like that, other than you got to see both sides. Like you gotta, it can't just be one person's fault in why things are happening, what have you. And I think a lot of it's for clicks. A lot of it's for views, watches. I mean, he makes money off this stuff, guys. And if he can speak, if he can get out there in front of people, he's making money and continuing to buy. Guess what he's buying with all the money that he's making? He's buying real estate because that's what he believes in. So regardless of all of his crazy things, the guy is still buying real estate, which tells you that, he believes in it. So Patrick Bet David, that's who I was trying to think of. Yes. Anyhow, that's where I'm at. All right. Will there be a recession or not, Josh? I
For
want you to tell me
sure.
right
No,
now.
no, no. The question
You
is for
tell me
sure.
right now. Will there be
I'm
one?
telling you, I don't know for sure. My belief is yes.
Are we in a recession
Mild to
now?
moderate. No, but
No.
close. No, but
Close.
close.
Why are we in a recession now? Are you
Well,
seeing employment?
tech,
Because employment, is that a metric we can use today? Is it the same? Is it measured the same way it was in 2007 or even 1991 or whatever? When employment was measured differently because of, whatever, different things.
we showed the chart at the top of the show.
Yep.
GDP is on a steady downward trend. I don't expect that to reverse until we get 2, 3, 4 negative quarters of GDP, which would indicate we have in fact hit a recession.
Okay. There you go. I believe we're in one, and that it will take some time. I mean, here's the deal. Even if we were in one, clear sign, the Fed would not admit that, right? They are usually lagging, like they are at the moment in certain things, in saying that a recession's happened. We're usually coming out of the recession by the time they admit that there is one. So is that where we are now? Hard to say, but I do think employment, because of boomers, because of the pandemic, because of the way the whole job market, employment changed during that period of time, I think the numbers are reflecting stronger than they would otherwise, which is showing that we don't, that employment is still better than they quote unquote, want it to be, I guess is the way to look at it, which in turn is saying that we're not in a recession. So that's my thought. I don't know. Could I be wrong? Absolutely. Right. David said Chat GPT told him the recession is coming. Well, that's good because Chat GPT is only as good as until like 2021, Josh, right? What was it, like October of 2021 or something like that? So it basically thought that 2 years ago then. So it's definitely coming if it's that old. Let's see. It's 5:54. 5:54.
Jeb, we have an important question from an MVP, VIP,
I know I saw that one and I forgot to click on
show.
it. Sorry.
Kim says, recently checked my credit. FICO score plummeted 57 points due to one of my school loans being removed without me knowing anything. Is this a bad thing? You can see it. It's kind of odd because school loans are installment loans, and installment loans don't have generally as big an impact when we pay them off. When you say removed, if it was completely removed from your credit report, if it was forgiven, removed, it can just take away that history that would increase the scores. Generally, I would say I wouldn't worry about it too much. I mean, if you need to do something right now, 57-point hit is going to be significant, but it generally recovers fairly quickly when I have seen this happen in the past. So I wouldn't lose any sleep over it.
There you go. There was a good Andy, can you explain how I would be able to get financing on an ADU? And I have a renter in mind. I have no equity on my house, so a HELOC is a no-go. So is there a way to finance improvements to a property, because we're going to call this an improvement, without having equity on your home, Josh?
Improvements, yes, but generally, say like an FHA 203K or a home style renovation loan, those don't generally consider the ADU an improvement. They consider it an additional structure. So I expect that to change over time, and we'll get more availability, because basically what those programs do is they use the after improved value. What is the value of this property once that additional square footage is on the property? And for the most part, they won't use an ADU versus, say, you add a bed and bath to your home. So I don't have anything jumping off top of my head right now, but if you reach out, I'd be happy to research it, because it's changing, and we're seeing more lenders reach out saying they have ADU friendly guidelines. Not so much Fannie, Freddie, FHA, VA, but lenders, private lenders that are out there doing their own stuff. So I'd be surprised if there's not an option. I don't know. Generally, when it's something that there's not a ton of options, it's not the greatest priced option, but definitely reach out. We can research it for you.
All right, guys, let's see. 48 likes. Wow, you guys don't like us. It's 177 people watching and only 48 people have liked the video. If you find any value tonight, hit the like button, subscribe to the channel. If you haven't done so already, go check out the Educated Homebuyer channel as well. Really trying to push that channel, grow that channel, and get out there in front of more people, providing education, guiding people through the process, really just trying to be, educators in the space and let people do with it what they want. That said, Josh, let's answer a couple more questions and then we'll exit here. How much have people put down on their property? So, Josh, what is a typical down payment amount that you see?
It varies. 20% is like a threshold that there are people like they're shooting for that. So we don't have a lot in that sort of gap between 10 and 20% down. A lot of 3.5%. A lot of people get past that threshold. They get to 5%, less at 10. And I think if you look at the nationwide averages for first-time buyers, it's like 6, 7, 8%. So a lot of those people have gifts from family members, so they have bigger down payments. Some of those first-time buyers, gentleman I talked to this week, he and his wife, first-time buyers, they've saved $120,000. They're going to put 15% down. So the most common is that 3 to 5%, but there are buyers putting bigger down payments, and our move-up buyers are generally just in a different position. If they're selling a home, they're walking away with a bunch of equity, and it just comes down to, are we going to take all of that equity and put it into the new house, or are we going to reposition some of that into investments, paying off debt, what have you?
All right, good stuff. So this is the part in the show where I ask a favor. If you're looking to buy a house here locally, Orange County, I can be of assistance, would love the opportunity. My contact information is in the description below. If Josh can help you on the mortgage side of things, you need a pre-approval, you want to have a conversation with a professional lender, you can reach out to him directly using the link that I'll put on the screen here. That said, that'll refer you to a lender anywhere in the country. If Josh works there, you'll get Josh. If it's somewhere that he doesn't serve, it'll be a professional in that market that we know, like, and trust. The same thing with real estate agents anywhere there. So use that as a reference point if you need an expert to talk to. Josh, we've mentioned the podcast. We've mentioned people subscribing and how much that helps us here on the show. What else would you like to add?
You left out our new project that in our spare time,
we
are starting an investment arm of our business. So if you have a distressed property, we're happy to come in and take a look at it. If a cash offer makes sense, if it's something that you can get more and get top dollar for it by actually listing it, putting it on the market. And that sounds crazy, but Jeb, we go back to that one that you had here in Buena Park a few months back. There are people that really just need that advice of how am I going to maximize my exit in terms of speed, money, all of that stuff. So that really is who we're looking at and reaching out to. So if you have a distressed property, if you have something you want money really, really fast, and I know this sounds crazy, but one of my investing mentors said, hey, people always ask why would someone sell a house at a discount? He gives an example. Back in the 80s, he found a house in Riverside that he loved for $650,000. It should have been about $1 million. He had that under contract, but he had to close in 2 weeks. He needed to find a cash buyer for his $350,000 house really, really fast. And he took a $75,000 haircut to get a $350,000 discount. So if for any reason you need money fast, want to get out of a deal to get into another deal, we would love to talk to you guys and help advise you on maximizing your exit from a property.
All right, guys, we will be back next Wednesday, 5 p.m. here on Jeb Smith's channel and the Educated Home Buyer. We'll see how that plays out. Maybe, maybe not. But until next time, guys, adios, amigo.